Okay, CMQ investors, welcome to the show. It is great to have you here. Today is Monday, March 7th, 2022, and I'm going to do something we've never done before, which is more or less a live news show. This is an insane time right now in the world, and I'm sure if you have any sort of investment, it's getting slaughtered right now. And so it's a good reminder, it's a good time to remind ourselves something that one of my heroes, Jack Bogle, used to say, stay the course. But I want to go through here and read some of the headlines from the Wall Street Journal, Barron's.com, Fortune, the Financial Times, and anything else that comes up kind of organically here. Let's begin, shall we? So first things first, obviously what's going on right now in Ukraine, the fighting between Russia and Ukraine, it's terrible. I mean, there's not enough things that I can say that would, ever, I guess, be original. I think everyone, anything that has been said worth saying about those situations has been said. Just know that it's very much top of mind. I know we're talking about money and investments. I'm not trying to take away from that or act like, that is that we're the victims here. That's not the case. But rather, I think this is a time for us as long-term investors to, as I said before, stay the course and remind ourselves why we're staying the course and just kind of get our heads around what's happening so that we don't lose our heads and do something that's, detrimental to our long-term futures here. So beginning off, first things first, and I don't have a car because I live in New York City, but it sounds like gas prices are surging. The Wall Street Journal has an article here that says the surge in gas prices isn't slowing down. Traders and shippers are shunning Russian oil, pulling millions of barrels from global supplies, empowering new increases at the pump. For my friends who are in Los Angeles, my friends who are just across the states, they say that the prices have been on the rise even before this started happening, but there's talk now that they could even hit $7 in some locations, that's pretty tough to get around and afford to get around when that's the case. It notes that diesel fuel has also skyrocketed. That's what it says here. It says diesel has skyrocketed, gaining 50% in the year to date as of late last week. And I imagine, when the gas prices go up, this affects all sorts of businesses, not just individuals. So something to keep in mind. I think it's also a reminder, too, that anything can happen. And this is just an example of that. Speaking of gas prices and just gas in general, there is news that Berkshire Hathaway has taken a stake in Occidental. And let me pull that up. I thought I had that article ready to go here, but let's see. Yes, according to Barron's, Warren Buffett's Berkshire Hathaway discloses a $5 billion stake in Occidental Petroleum. And the article, written by Andrew Barry, goes like this. Berkshire Hathaway owns a 9.8% in Occidental Petroleum worth $5.1 billion after furious buying activity in shares of the big energy company this past week. Berkshire Hathaway disclosed late Friday in a Form 4 filing with the Securities and Exchange Commission that it held 91.2 million shares of Occidental Petroleum, and that trades with the ticker OXY like Oxy. And that's up from 29.8 million shares on Tuesday, which was disclosed in a separate 13G SEC filing on Friday. To be totally honest, I'm not totally sure how these filings work. I know the 13Fs are released, the following quarter after purchases are made, but I don't know what a Form 4 is or a 13G filing is, but that's something I can look up on my own time. On Friday, Barron's reported that Berkshire was holding 29.8 million shares, but not the full holding of 91.2 million shares that was reported later that day in a separate filing. So I'm not going to go through and talk about, on this day they bought 7 more shares and they bought another 6 because that's pretty boring. But the quote here from Bill Smead says that Buffett and Combs and Weschler require a large margin of safety. They must have concluded that Oxy has the safety around $46 to $55 per share, with oil above $90 per barrel. And this guy, Bill Smead, I shouldn't call him this guy. He's the manager of the Smead Value Fund, and he's quoted here in this Barron's article. His fund also holds Occidental stock. I like that he mentioned the margin of safety. That's something I've been thinking a lot about. We've been discussing it. I'd like to eventually do a full episode on that concept because it's a critical component to understand and to apply as a long-term investor. And it's something that, to help you understand Berkshire's moves and more broadly speaking, Warren Buffett and Charlie Munger's moves, and understand those moves more clearly, I should say. And again, I'm just jumping around here with these articles I have pulled up. Going back to Russia now, Chinese tech firms are also looking to potentially either stay in or pull out of Russia after most of the West has pulled out of their positions in Russia, which does really sound. I really sound smart right now. I sound like a real wizard. I'm like, the West pulled out, so yeah. Hong Kong, and this is from Dan Strump from the Wall Street Journal. As Western tech companies halt sales to Russia following its invasion of Ukraine, their Chinese rivals have an opportunity to capitalize on their departure. Oh, that's nice. Doing so won't be easy in the face of growing logistical, financial, and legal hurdles. Companies that have suspended sales to Russia include smartphone makers Apple and Samsung Electronics, PC manufacturers HP and Dell, and telecom gears provider Ericsson AB. Their exits come as expansive sanctions by the U.S. and allies on Russia prompt companies to review business ties there. Chinese tech giants, however, have stayed silent and show no signs of joining the exit. Many have strong ties in Russia over recent decades, capturing more than 40% of the market for some tech products. They often take their cue from Beijing, which has declared its opposition to U.S. sanctions. While Russia is a small tech market by global standards, it accounts for about 2% of global smartphone and PC shipments. It is Europe's largest phone market and a competitive tech battleground where Western brands vie with Chinese rivals for top billing. Interesting. We'll keep an eye on that one. Also, this is another effect of what's going on right now because the market's obviously responding very negatively to all sorts of global unrest that we are now experiencing. This is another Wall Street Journal article from today, and it says that U.S. retirement funds, which are heavy on stocks, brace for losses. Volatile stock markets are eroding the retirement savings of American teachers and firefighters after public pension systems ended last year with equity holdings at a 10-year high. Public pension funds have a median 61% of their assets in stocks as of December 31st, up from 54% 10 years ago. Since then, the Russia-Ukraine war, since then, the Russia-Ukraine war and expectations that the Federal Reserve will raise interest rates this month have battered equity prices, reducing those holdings by billions of dollars. As the nation's largest pension fund, the California Public Employees Retirement System, which has a total reported holdings, their total reported holdings, you know what I should really do? I'm going to get better at doing these live reads. It says their holdings have fallen $475 billion as of March 2nd. But let me stop this really quickly because this is where I think CMQ, we can jump in and kind of, just cool it for a second. Obviously, this is concerning, right? If people's retirements, we want that to be protected and we want people to have a retirement. But this is a good example of information that is true, but not necessarily that helpful. Because, stocks are all taking a hit. You just have to load up your portfolio and you will see the impact of global unrest on your portfolio. The question is, what do you do about it? Do you take your money out now and just, hope that, you're safe? Do you ride it out? Do you call up your stockbroker and start screaming at him or her? I don't know. I also don't understand if you have let's say if I'm a public school teacher in California, how much control do you have over, what percentage of your money is in stocks versus bonds, et cetera? That I don't know. But, the lesson here and lesson forever, it's one of these enduring lessons we try to focus on is, it's not about timing the market. It's about time in the market. And going back to one of my heroes, Jack Bogle, just stay the course. I was watching a video last night. It was part of a video I'm putting together of Warren Buffett clips from some of the more popular videos we've uploaded to the Instagram account Warren Buffett Videos, which actually just hit 10,000 followers. So, I'm sure that's just a little bit of a bright spot in a terrible news cycle. But I was going through those, and there's actually a clip from, I think it was around mid-2010s about Ukraine, because there was unrest with Ukraine and Russia previously. And Warren Buffett was asked about this, and he said, regardless of what's going on in the world, that doesn't affect my choice to invest or not. And Warren Buffett described when he bought his first stock, the U.S. was in all sorts of trouble. Pearl Harbor had just happened. It was, the world was a messy place. But he said he went all in. And I'm not suggesting you go all in or that you follow I think he was 11 years old or something at the time. But the point is there will always be these global situations. We can't predict them. We don't know when they'll happen, but they will continue to happen. The hope is that we can minimize, obviously, civilian deaths and hopefully have less of this type of conflict as we evolve as human beings. I'm not making any guarantees there because, I would have thought, cooler heads would have prevailed in this situation, but that's obviously not the case. But, as you read an article like this, and there's nothing wrong with the Wall Street Journal for publishing it, but, what are you going to do about it? This is the information that can easily get you off your game. And that's why I'm glad I'm reading it, so that maybe you can hear my voice in your head before you panic sell, or hear Jack Bogle's voice going, just stay the course. Okay, in other news, and this is kind of weird to me. In China, COVID-19 cases have hit the highest daily total since 2020 Wuhan outbreak. This is very strange to me. I'm in New York City. That's where I'm recording this right now. People are starting to really take those masks off. Now students don't have to wear masks at school, which is just, I think, a really positive thing. But this article notes that China logged its highest daily total of locally transmitted COVID-19 infections in more than 2 years, with the highly transmissible Omicron variant posing a fresh test to China's ability to quickly smother outbreaks. China's National Health Commission said Monday that it had detected 526 domestic infection cases, 214 of which were symptomatic. And that's the highest daily tally by either measure since the initial pandemic outbreak in early 2020. Most of those who tested positive on Sunday were in the eastern port cities of, and I'm not going to even try to say the names because I will sound like a complete moron, and with others detected in the southern provinces, and it sounds like it's everywhere. So what I'm curious about here, though, is are they doing the vaccine there? What's the situation? Because I'm a little confused, because I thought China had those heavy-duty lockdowns. I don't want to go any deeper in this because I'm not a subject matter expert, but I hope it gets figured out, because it's obviously a shame that anyone's still contracting this and dying from it. So another thing to make your portfolio go down. Uncertainty about COVID. Speaking of, not speaking of COVID or anything related, but Shake Shack is testing Bitcoin rewards to lure younger consumers. And I want to point out, before I even read this, I haven't read the article, but before I bring this any further, this is how I see a lot of brands using Bitcoin, and it can be seen as a positive market signal, but it really is just marketing. I remember when, I think it was AMC was offering, you can now pay with Dogecoin. It's just good marketing. It says that Shake Shack is offering the cryptocurrency Bitcoin as a reward for purchases made using Cash App, which is a digital wallet offered by Block Inc., formerly Square. Customers will receive 15% of their purchase back in the form of Bitcoin on any Shake Shack purchase made with Cash Card, a debit card available to Cash App users, and by buying items via Cash Boost, a rewards program available to Cash Card members. Now, I tried to order some Shake Shack recently. This is a true story on Seamless, because I was just feeling like a big fatty. And it was really, I got a milkshake with it. I was really excited about it. I was extremely stressed out, and Shake Shack just sounded pretty good. So my order shows up, and the person who put it with the delivery person did not secure the top of the milkshake, to which I was told that my milkshake had been dumped basically over everything. And I didn't have a good customer experience because there wasn't any follow-up from Shake Shack. And if anyone's watching this, I'd like free Shake Shack for life. Thank you. That's all I'd like to say on that. And I don't need the Bitcoin rewards. Okay. All jokes aside, this is kind of interesting. Last thing from the Wall Street Journal here. If anyone watches football, it says that Troy Aikman, Tony Romo, and the NFL's $1 million a game announcer club. For those of you who don't know, some former quarterbacks are making like NFL level, like NFL star money to be the announcers. It says, fueled by big ratings and fresh competition, the NFL's signature voices are ready to cash in. Speaking of signature voices, this signature voice is also ready to cash in. So holler at your boy. My friends, it appears we all made a technical blunder with our life. Let me say that again. This is by Jason Gay of the Wall Street Journal. My friends, it appears we all made a tactical blunder with our lives. We did not become NFL television analysts. Why do I say this? Because we are amid... Sorry, this is great. I like how he started that. Because we are amid the greatest financial windfall in history for people who can travel to one football game per week and say, I'm not sure that was a catch. He writes, okay, the job was a little more complicated than that, but still. The revolution began a couple of seasons ago when gridiron Nostradamus Tony Romo got a reported $17 million a year to sit next to Jim Nantz in the CBS booth and predict that the Titans are probably going to hand the football off to Derrick Henry. For those of you who don't know what he's referencing, Tony Romo, former quarterback for the Dallas Cowboys, there's YouTube clips of him predicting the plays because, again, he can read the defense very well and I think just read everything on the field very well. But it's pretty funny because he was pretty spot on, at least in these best of YouTube clips. Now it's the report via the New York Post Andrew Marchand, who's dominated the beat, that Romo's Cowboy predecessor, Troy Aikman, is girding to bolt Fox News for I don't even know. This is good. I read the Wall Street Journal. I have new words to learn here. He's leaving for ESPN, where his salary will reside comfortably in Romoville. Holy wazoo! That's $1 million per regular season game, $250,000 a quarter. If an NFL game is truly 11 minutes of action, as the Journal famously reported, that's close to $100,000 per minute of actual football. I'm not going to go any further with this. This shouldn't be surprising. I mean, if you are in front of a huge audience like this, and it's the announcers are a big part of the draw, they should get paid. They should get an equitable piece, of the revenue. So I'm not upset about this. I think it's a lot easier said than done to do what they do. Although I understand how someone, and all of us who work hard, would be like, well, how come I can't get money to call a football game? Well, you also probably didn't take a beating for however many seasons those quarterbacks did. I'd imagine every morning when they get up out of bed, they hurt. So consider that next time you're feeling jealous. And as Charlie Munger would say, there's no point. Envy's a dumb thing, because envy, as he says, is of all the 7 sins, envy's the one you don't get to have any fun with. Charlie Munger himself. You like how I just brought that in together, guys? If you're watching on IG Live right now, that's a good little reference. Okay, let's see what else we have here. So, that giant house in California, I think it's in Los Angeles, it was selling for $141 million. I want to say it's the one that Dan Blazarian had pretended was his, but I could be wrong on that. Well, now it's sold, and it's sold to the gentleman who's the CEO and founder, or I think he's at least the owner, of fast fashion business Fashion Nova. I'm not sure. I know Fashion Nova. I know what it is. I didn't realize how big of a deal it was. But he has bid and won on this Los Angeles mansion, which is known as The One. The 21-bedroom, 49-bath Bel Air. What, 49 baths? Are you serious? It's sold. So think about that. That's more than 2 bathrooms per bedroom. That seems unnecessary, but hey, so be it. The 21-bedroom, 49-bath Bel Air estate sold Thursday for $141 million. Not bad. He beat out 4 others for the 105,000 square foot home. Holy moly. The biggest U.S. home ever to go for auction, according to the LA Times. He owns 2 other homes in Southern California, and says that there's nothing else like it. As a lifelong Angelino and avid collector of real estate, I recognize this as a rare opportunity that also lets me own a unique property that is destined to be a part of Los Angeles history. Something to keep in mind there, guys. If you start a company like Fashion Nova, you too can spend $141 million for a house that has 49 bathrooms. What a life. What a country, America. All right. Let's see what else we have here. Senior Democrat Ron Wyden warns against tough clampdown on crypto. One of the Senate's, and this is from the Financial Times, one of the Senate's most powerful Democrats has warned his colleagues against cracking down too hard on the booming cryptocurrency industry, likening it to the internet in its infancy. Ron Wyden, who's the chair of the Senate Finance Committee and one of the architects of U.S. internet regulation, urged members of his party to protect crypto innovators despite concerns about fraud and money laundering within the industry. Wyden's warning comes as senior officials in the administration of Joe Biden look to clamp down on unregulated crypto activity, especially on popular trading platforms such as Coinbase. Wyden told the Financial Times, quote, "There is obviously a debate about stricter regulation, but I want to be on the side of the innovator. When I think about crypto, I think about remittances, or somebody who has a kid 1,000 miles away and wants to get them help in an emergency, rather than going through scores of banks and credit card companies. I keep looking for innovations," he added. "That's where my heart lies." The demand for cryptocurrency has rocketed in recent years, driving the total value of coins to about $2 trillion. Their popularity has caused alarm among politicians and regulators who have warned about the possibility that they could be used for fraud and money laundering. As I've joked about in the past, if you ever find yourself locked in the back of someone's trunk, your family will likely need to pay Bitcoin to get you out of the trunk. And I hope that never happens, by the way, but just want to make that clear. Wyden's comments contrast with those of his Democratic colleagues, but they echo similar ones made by a small but increasingly influential group of members of Congress who have championed the crypto industry, from Republican Tom Emmer to Democrat Roy Khanna. Wyden likened the industry to the internet in its early days when he and colleagues in Congress drew up legal protections for online platforms so they could avoid being sued for content that users post on their sites. I won't get into all the nitty-gritty here, but something to keep an eye on. I think there's going to be a continuing movement there where you have a little bit of a back and forth between regulators, politicians. There's going to be lobbying and everything you would expect in any new space. Okay, what's going on in the stock market today? First question is, well, I should say, first thing to think about is don't think about it too much. But it says that the Dow falls, oil and gold surge. And if you look at your portfolio, which I said you shouldn't do, if you do, just get ready to throw up because it's not having a good day. And I wouldn't expect it to get much better as long as there is a potential of a nuclear war being discussed. I'm not laughing because it's funny. It's not funny at all. It's funny because it's tragic and sad. I laugh not to. I'll come back to this later, but I'm definitely not laughing at that situation. You guys know that. But I have to be careful because someone heard an episode that they more likely had never heard an episode before and misinterpreted my attempts to keep you guys engaged and interested as me making fun, which is not at all what I was doing or will ever do and will never do with something like this. So we talked about Berkshire and Occidental. We talked about the mansion. There's a question here about should Amazon, Microsoft, Google, and other cloud companies face more government oversight? I'll leave that up to the government to figure that one out. Another article that I'm looking forward to reading in the Wall Street Journal that's not really related to CMQ, but it's how Devin Booker's life was changed by Kobe Bryant. So I'm curious to get into that, and if anyone likes basketball, if I know more of our audience does, I could always talk about that. So going back to the bigger picture here, guys, on this news front, and not making this so much about every day we need to read the news and try to become something like that. I think it's the bigger point is what are some big ideas? What are some enduring ideas we can take out of this situation? Remind ourselves so we don't get caught up in the noise and make a bad decision. If you talk to people who've gone through financial panics or financial crashes, recessions, you name it, one of the things I often hear is they regret selling. Now, I don't know what's in everyone's portfolio, and I would never suggest or tell you what you should do because it's not my place to do it. But I know for myself, I know what I own. I feel confident that I didn't overpay for what I own, and I'm a long-term investor with a long time horizon. I've got my emergency savings. So I've put myself in a position where I should avoid panic selling and be able to prevent myself from panic selling. With that being said, it's still not nice looking at your portfolio when just a few months ago, I thought I was Warren Buffett, and now I feel like I'm Warren Buffett. So that's just what's going on. If you guys have any questions, I'm on IG Live. You can ask me now and I'll answer them. I know people are wondering what's up with Alibaba. How's Alibaba doing? So I can speak to that, but not surprisingly, Alibaba's down a little bit today. But earlier this morning, it was one of the only bright spots in my portfolio. But again, I have to remember long-term, 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 and long-term. So this has been the CMQ Investing Podcast. A little bit different today, just trying something new. I'm going to continue to experiment. That doesn't mean that it's going to become anything different than what you've already grown to like and expect from it. But as we continue to evolve here, I want to, use my, I guess just my natural sense to experiment and do new things and find new ways to deliver value to you guys. And for me, I think when we talk about these current events, it's again about bringing them back to these big ideas that really work. If I think back to something that I've heard Charlie Munger and Warren Buffett say, which is, over the course of their investing lifetimes, they've seen their shares in Berkshire go down 50% from ticker to ticker. They didn't sell anything, and hopefully if you own something as quality as that, you won't be tempted to do the same thing. Remember, our stocks are assets. I've heard Warren Buffett reference this. If your house went down in value, just based on valuations, you wouldn't rush to sell your house. But yet we act completely different when it comes to our equity holdings. So just keep that in mind. Remember, try not to time the market. You can't time the market. Don't put yourself in a position where you're over leveraged or you're in a spot where you have to, you have to sell because you need the cash. That's always important, and it's something I've tried to share, my own experiences with and how I avoid putting myself in that position. Thank you for listening. This has been the CMQ Investing Podcast. Please make sure you follow on Apple Podcasts or Spotify. Leave a 5-star rating. Leave a written review if you're on Apple. That goes a very long way. And just know that I appreciate all of you for supporting the content. Thanks again, and we'll talk soon.